Good morning, everyone, and welcome to the monthly economic briefing presented by the Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm External Affairs Assistant Director Rob Knapp, and it's great to have you with us this morning. So, how was your week? The U.S. economy and the world economy have had a bit of a week so far, and it's only Friday morning on the East Coast here in the U.S. So we have a lot to talk about today. Talking to us will be Professor Camelia Kuhnen, who is the research director at the Kenan Institute. She'll be along in a moment. She'll talk about today's employment numbers, which are very nice. She'll talk to us about consumer confidence and consumer sentiment. Not so great lately, but she's really going to go in depth on that and give us some more insight than just the big numbers on that. Who knows, there may be some talk of tariffs. Those are a little higher since the last time we got together. So much to talk about. Professor Kuhnen will be on in a moment. She's going to present for 15 to 20 minutes, and then she's going to take your questions. You can ask those questions at any time during the briefing, even now if you want to. You can use the Q&A function at the bottom of your screen to do that. For those of you in the media, if you could include your organization names when you submit your question, we'll make sure to move your questions to the front of the line. For those of you who are with us by phone today, you can ask questions as well. Please email them to me. I'm at rob_knapp@kenan-flagler.unc.edu. I will keep a lookout for those. Like I said, we will look to finish this up about 9:30 today, although I assume we may have a lot of questions. We'll try to get as many of those answered as we can. I think that's all you need to know to move forward. So I will introduce our research director, Camelia Kuhnen, who I imagine has a lot to say this morning. Cami, good morning. How are you doing?
Good morning. I am good. I will share my slides with you in just a second here.
Okay.
All right, it's been an eventful week, but today we actually have some good news, and I'm delighted to tell you a bit about this good news. And then we will see if we're going to continue to be happy after this morning's report or not. So why is this report good that we just got from the BLS this morning? It's good because the actual change in non-farm payrolls was much higher than expected. We expected 140,000 new jobs. We got 228,000. Now, there were some revisions to numbers from previous months, but overall, basically the economy is looking good in terms of number of new jobs added. Manufacturing payrolls haven't changed much. This is a pattern we've seen for quite a while now. In terms of average hourly earnings, that figure is also pretty steady at 0.3% gain from month to month. We have seen this monthly increase, this monthly growth rate in hourly earnings really for the past year or so, pretty consistent. Also, the number of weekly hours worked is pretty steady, just like we've seen in recent months. The unemployment rate ticked up a little bit from 4.1% to 4.2%, but really it's still very low relative to historical standards. And the labor force participation rate remains very close to what we've seen in the recent past. It's 62.5%. So really, this report was good. I was concerned about what we might see in terms of the non-farm payroll numbers, but the U.S. economy, at least the labor market, appears to be quite in good shape. And I'll go into why this might be the case. I think that a lot of firms have been basically hoping that the tariffs that had been promised won't actually go into effect. So firms did not really engage in layoffs or did anything dramatic up until this past month. We will see how this all changes after what we've seen this week in terms of tariff announcements. The situation, the numbers we will see from these employment reports in the next couple of months might look very different from what we're seeing this morning. I think that this morning's numbers reflect a solid labor market based on how the economy has been doing for the previous year or so. And it doesn't quite tell you the concerns that right now today are on people's minds. And I'll go through those concerns in just a second, right? So here are the numbers. If you want to get a more long-term perspective, this month's number of jobs is really quite respectable relative to what we've seen in previous months. So all good here. In terms of wage growth, it's been steady. It's above the inflation rate. And the fact that this wage growth has been above the inflation rate is actually one reason why we've seen healthy consumption and healthy GDP growth during 2024. In terms of the unemployment rate, like I said, that number is quite low relative to historical standards. Really, the labor market, if you look at these numbers, looks quite good. And this was not the only report in recent days that looks good. I'm going to show you some JOLTS figures in just a second here. We're in good shape again in terms of the labor market. The labor force participation rate remains quite high for both men and women at pre-COVID levels for prime age workers, though in terms of the participation rate of older individuals, it's below pre-COVID levels, and it doesn't appear to bounce back. So I think older workers may not come back to the labor force as much. The JOLTS numbers that I mentioned are looking pretty good too. We got these numbers on April the 1st, and what we saw was a pretty steady number of job openings, 7.6 million in February. The rates of quits and hires and layoffs, they were really very steady compared to the previous several months. So the JOLTS numbers and today's numbers again say to us that as of now, the US labor market is on really solid footing. If you look at this ratio of job openings per unemployed worker, that was really high right around March 2022, when firms wanted workers and people didn't really want to work. That ratio is now at a much healthier level of 1.07, and it means that the labor market is basically in a good equilibrium. Now, you might wonder, do we see any effects from federal layoffs? In terms of the raw numbers, the answer is, well, the effects are tiny, and that's because the federal government only makes up for 1.8% of the civilian labor force if you don't account for active military personnel. And so you won't see a lot of the layoffs or separations be driven by what's going on with the federal layoffs. Now, those layoffs, of course, are going to have a downstream effect because of the funding that's also being cut. So there will be probably some impacts on the layoffs overall because of the programs being cut, not because necessarily the number of federal employees that are losing their jobs. So they are losing their jobs, but they do not make up a large number or a large fraction of the labor force. GDP growth has been really good over 2024. Overall for the year was a growth rate of 2.8%. But if you look now at GDP forecast for this year, we have a very concerning minus 2.8% real growth rate projection from the Atlanta Fed as of April the 3rd, which is in part due because of these concerns about what the tariffs might do to economic activity. And we have these recession estimates, probability of recession estimates from a variety of parties that are quite concerning. For example, JP Morgan last night gave it a 60% probability that we'll see a recession this coming year. And so why is it? Why are we expecting a recession given that we've seen, again, a solid labor market and really good GDP growth in the past few quarters? Well, it's this uncertainty that we've seen go to very high levels lately. So the uncertainty about fiscal policy, about tariffs is very, very high. You can see it reflected in this economic policy uncertainty index that I'm showing you here. Uncertainty is really bad because it delays foreign investments, it delays household consumption, it will probably drive firms eventually to go through hiring freeze and through layoffs. So I am very worried about this uncertainty number. You see it also if you look at small businesses, their uncertainty levels are really at a very high level. So because of this, we are all worried that there will be an economic slowdown. Again, in spite of what looks like a really solid past year of GDP growth and labor market conditions. The inflation rate, so far it's not terrible. It's actually it's around 2.8%. If you look at core PCE, it's picked up a little bit in the recent couple of months. So, if I were the Fed and if all I was looking at it was just inflation numbers, I would maybe not cut interest rates right now because we still want to have that rate go closer to 2%. But the Fed knows that consumers and firms are now really concerned about what the tariffs might do to the economy. We know we have this very high perceived uncertainty level. So right now, the Fed funds rate is around 4.25 to 4.5%. Likely, we will see a cut starting in June. For May, the chance of a cut is only about 45% as of now, but June is a very likely month to see the first cut. By a year from now, April of next year, probably we'll have interest rates be the target rate be between 3 and 3/4, between 3% and 3.25%. So we'll have maybe 4 to 5 quarter point cuts in the next year or so. Why? It's because the Fed probably is going to be much more concerned about the slowing down of economic growth rather than the slight increase in inflation. Households are worried. They probably should be worried. They've had a low personal savings rate since the years right after COVID. There is this high uncertainty about economic policies, and we'll see in a second, they have they display a lot of pessimism in their expectations for future economic conditions. So we will probably see a drop in consumer demand. We've actually seen something like it in the recent couple of months. This picture shows you that spending growth was faster than the growth of income during most of 2024, but it slowed down at the end of the beginning of 2025. And you can see it in this picture too. So if you look at these bars over here, this represents spending in January. Spending went down in real terms compared to the previous month, especially spending on goods, but then it bounced back a little bit in February, and spending on goods, in fact, drove a lot of that bouncing back. So will we see in the next month spending actually go up? Maybe, and I think that if we see that, it's probably because people are shopping before or have been shopping this month to sort of get stuff cheaper now before the tariffs actually hit. I mentioned consumer sentiment. It's not looking good. If you look at in the previous couple of months, for both the consumer confidence data and for the Michigan data, there's a drop in confidence that's quite remarkable. If you look especially at the Michigan data, this is a huge drop. Normally, month-to-month variation in these numbers don't really predict much in terms of consumer demand, but these are large drops. So I am concerned that households are getting into this situation of being very worried about future economic growth, about the labor market, and so they'll stop spending. That's a problem because spending really represents 70% of U.S. GDP. So U.S. consumers have to be to feel in good shape for our economy to grow. There's a part that's even more concerning about these expectations. If you look at the Michigan numbers, they also ask people about, as part of the consumer sentiment survey, they ask people about the inflation expectations for the next 1 year and next 5-year horizon. And these inflation expectations, which were pretty well anchored at the end of 2024 around the number that probably the Fed found comfortable, close to 3%, still above their target of 2%, but pretty well anchored relative to historical household expectations. Well, those expectations jumped way up in the recent couple of months. Right now, households expect an inflation rate of about 5% in the next year and about 4% in the next 5 years per year. So that's worrisome. And it's not just households that expect high inflation. Actually, the market too expects inflation to go to be in the 2.5 to 3% almost in the next year or so. Now, why is this? Well, evidently, inflation will happen, at least in the short run, when tariffs hit, prices will go up, but it should not be a sustained, or there can be a situation where it's not a sustained inflationary period. After this one-time jump in prices, we could see prices flattening if, of course, there are no trade wars and retaliation that continues over time. And so we'll see how that plays out. But for now, households definitely are concerned about future inflation. Now, that being said, there are some good things that I want to point out about the health of households. So their balance sheets look good in terms of the net worth of all households, whether or not they're, the bottom or the top of the wealth distribution. Those balance sheets over the past several years have gotten better. Net worth has increased over time for all people, or all of the deciles or quintiles, however you want to look at it, in the wealth distribution. And importantly, a lot of Americans are homeowners, right? On their balance sheets, on the asset side, they have homes, and those homes increased in value tremendously, 48% since February 2020. Two-thirds of Americans actually own their homes, and 40% of the homeowners, in fact, own their homes outright. So that's an asset without a liability against it. People use these homes through what's called a wealth effect, basically finance consumption. And so I think that while it's scary right now, the uncertainty is super high, and we're concerned about a slowdown in economic growth. We shouldn't forget that the balance sheets of households are really healthy. If you look at the leverage ratio of these households, it's way better than it was, close to the great financial crisis, for example. So I think that households can basically save us. So I'm positive. I'm optimistic because of this. And now let me finish with an observation that might be new to some of you, which is that there's been a change in the sentiment of young people over time. So this is a picture based on data from the survey of Michigan consumers. This is the sentiment index. This one here is an index of consumer expectations, so beliefs about the future. And what you see from both of these pictures is that over time, throughout the entirety of the time when Michigan has done the survey, actually since 1978, so way beyond what I can plot in this figure here because of space limitations, young people, those 18 to 34 years of age, have been more optimistic about the economy relative to middle-aged or older people, right? So if you look at the blue line, that's young people. The red line are older people, 55 and older. Again, if you look at the overall sentiment by age group, or if you look at the expectations, just about future conditions, not about current conditions, but what do you think will be your situation like in the future? Younger people historically have been more optimistic than older individuals. But what we've seen lately is actually this compression in optimism, and that younger people, the younger generation, has become less and less optimistic. This generational gap has shrunk. And in fact, in the past 3 months or so, we've seen that younger people, 18 to 34 years of age, are actually more pessimistic about the economy than older individuals, 55 and older, in terms of the sentiment. And this is driven actually by the expectations about the future, not about the current conditions, right? So as of right now, everybody thinks they're okay, but thinking about the future, it's younger people who are more concerned. You see here this index, this blue line for young people is way below the one for old individuals. So this is concerning. This is a rare event, by the way. So if you look at all of the months for which we have consumer sentiment data, in only about 2.5% of these months, so really tiny fraction of the months, do you see young people be more pessimistic about the economy compared to old people. It's only 13 months of the entire sample since 1978 that this has happened. And 3 of these 13 months of youth pessimism or young people pessimism have been the last 3 months. There's something going on right now that's concerning to me, because I think that if young people have lost faith in the US economy, they're not going to make the kinds of investments that are going to put them on a good path that will also help our economy look good in the future, in the next couple of decades. So I'm going to explain just in a second here why I think that the younger people are sort of demoralized right now, and I think it has to do with the fact that they are not the asset owners, right? Older people are those who own homes, who own stocks, and if you see the trajectory of real wealth by these generations, it's going to explain to some extent why we've seen this compression and optimism between young and old people. Older people have gotten a pretty fast accumulation in terms of real wealth over time, especially in recent years. Younger people are pretty flat, right? So right now, if I'm young, it's very hard for me to buy a home. It's very hard for me to acquire assets to finance my retirement. These assets have all increased tremendously in price, right? A home right now costs so much more, but my wage, even though it went up in real terms a little bit, it really cannot make up for that huge increase in the price of the asset I'm looking to buy the house. So let me finish here. I think that consumer confidence is where the drop in that is pretty concerning right now, and I'm worried about these younger individuals, younger workers. Will we have a recession or a slowdown? It depends on a bunch of things. Do we see a lot of retaliation from other countries? Do we see consumers and firms respond a lot to uncertainty? Will the Fed lower interest rates a lot? Will it lower them quickly? All of these are things that we don't know much about right now. So a lot of uncertainty remains about the pace of economic growth. Overall, I guess we can say for sure that at least we'll see weaker growth relative to what we saw in 2024. We will probably see the labor market conditions worsen. There will be these federal layoffs as well as the cut in federal funding, plus the hiring freezes and layoffs driven by tariff-related uncertainty will for sure worsen the labor market conditions. Inflation probably will increase, will be about 4 to 4.5% over the next year. And I would expect to see the Fed cut rates by between 1 and 1.25% in the next 12 months. So that's where we are.
Thank you very much, Cami. That was a whirlwind tour on a kind of a crazy morning, even for the briefing. You had a lot of ground to cover, and the information you had about young people and confidence is fascinating. And I think it would be great to dive back into that the next time you're here and see how that's progressing, because those are some fairly disturbing numbers and could mean a lot of different things. We have questions, so we'll get right to those. I wanted to remind people, if they do have questions, please use the Q&A function at the bottom of your screen. We will pass those along to Cami. And if you are with us by phone, you can email me. I'm checking my email just now. I'm at rob_knapp@Kenan-Flagler.unc.edu. To the questions, this one's from Matt Boyle at Bloomberg. Good morning, Matt, and thanks for the question. This job report is positive, but isn't it already ancient history given the tariff regime we're now entering, which raises a good question about the speed of things happening in Washington. Do monthly reports keep up with them anymore?
Well, I think that the report itself is accurate. It's telling us about the situation in the labor market as of basically a couple of weeks ago. So I think this is accurate data, which reflects how things have been up to basically now. But since the new tariffs were announced 2 days ago, I am sure that many firms and many US consumers have changed their plans for consumption and for investment for sure in the near future. So I think we need to have these numbers. It's kind of good to know where are we starting from, right? If we're going to face these headwinds that now have occurred for sure, we have these tariffs. Are we starting from a solid footing in the labor market? And the answer is yes. So that I take this over starting from a situation with really high unemployment rate, for example.
Okay. Matt had another question. This touches on something that you spoke a little bit about. Do you expect consumers to rush out and buy items most impacted by tariffs, sneakers, wine, et cetera? And what impact will this have on consumer debt and discretionary spending levels?
Great question. I'm willing to put money on this. When we look at the consumer spending expenditure data next month, we will see for sure a month-to-month increase, because households are now trying to buy those items that are going to increase in price in the next few days. So, will this have some people get close to basically default because they're perhaps borrowing money to be able to finance this consumption to get ahead of tariffs? Yes. Now, generally speaking, like I said, the leverage ratios of most American households are nowhere near what they were in 2007 through 2009. So I don't think we're going to see a lot of consumer defaults. That being said, there are some items, for example, cars, that are going to increase in price dramatically. They already are much more expensive than they were before COVID, whether you're looking at used cars or new cars. And these prices are going to increase even more in the next probably month or so. And this is going to really have an impact on the monthly payments that consumers will have to pay for these items, and it will bring some households very close to a threshold where they might not be able to make these payments. So there is a sort of a rule of thumb that when you buy a car, whether it's used or new, you do not want to pay more than 10% of your monthly income on that monthly payment for that car. And once tariffs are put in place, there are estimates indicating that people are going to actually have to pay something like 11 to 13% of their monthly income to be able to afford these cars. So we will see households for sure feel the pinch of these higher prices, and these monthly car payments are going to be quite a decent chunk of that pain.
Okay, thank you. A couple of questions about the Fed and the questions that they face. One person asked, even if the Fed cuts quickly, can that forestall a recession?
Well, right. The question still is, will there be a recession? So let's. It may be that if the Fed cuts and offers reassurance for further cuts, that we will just see a gentle slowdown. It is possible. Now, if you look at the stock market reaction from yesterday, and if you look at the futures data for today, investors are really thinking that the world's economy is not going to go in a good direction, right? And so I think that there are bets that there will be a lot of retaliation. We've seen China already retaliate this morning with their own tariff on U.S. goods. So if basically the whole world is in a trade war, there is very little that the Fed cutting 1%, let's say they go all the way 100 basis points cut, that is really going to save the world from a recession. So the hope is that the trade war is not going to be that intense. Maybe we'll be able to negotiate some deals and lower these tariff numbers. But if it's a full-blown trade war, honestly, I don't think that the Fed can save us from that. It's the fiscal policies of various countries are going to drive the extent to which we see a recession or not.
Okay, and hold that thought on trade war. We're going to come back to that in a second, but I had one more Fed question that I wanted to fit in. Another attendee asked, isn't raising rates the only way the Fed can combat high inflation? And if so, why would they lower 1.25 percentage points if inflation increases 4 to 5%?
Well, the Fed has this dual mandate, right? They have to worry about inflation, which really refers to a sustained period of price growth, right? So it's not just inflation is not just, okay, this month prices went up by 5%. I mean, it's bad for that 1 month. It's that inflation reading will be bad. But if that price level stays flat afterwards, then you have zero inflation. Yeah. So what the Fed is worried about are these sustained increases in the price level. They don't want to have that. But also the other part of their mandate is to make sure that unemployment stays low. So they have to balance these two. And if you have, everybody be so concerned, so uncertain, as we saw in those uncertainty indices, the Fed has to worry that firms are going to go through layoffs. They're going to at least for sure put hiring freezes on. Consumers are not going to buy anything after the tariffs hit. So the Fed has to balance these two parts of their mandate, and that's why most economists, and also if you look at data from the CME based on basically how we price future interest rate cuts, we see that the market believes the Fed will actually cut. They are more worried probably about the labor market conditions than this possibility of inflation. Will the pace of cutting be different if we see that inflation is actually going to persist? Of course. In fact, Jerome Powell is going to give a talk later this morning. He might provide some more clear details on what they are trying to do. But as of now, the market believes that the Fed will focus right now more on making sure that we don't lose economic growth and less so on taming inflation.
Okay, it was funny this morning to check the front pages on a briefing morning when there's usually a lot of talk about what the employment numbers are going to look like, but there was so much going on. It was hard to find that information this morning. Just a reminder from you, I think, that employment numbers still count, and there's still going to be things we're going to be looking at very closely in the coming months. Okay, back to trade war. Richard Ryden asks, can you speak to the typical historical outcomes of a global trade war, and are we in a similar place?
Very briefly, trade wars are bad. They do not encourage innovation. They do not encourage economic growth. We do not want to have them. And the current trade war, or the beginning of it, that we've seen is not any different than, I believe, what we've seen in the past. So I'm not particularly encouraged by having high tariffs and retaliation from other countries.
Okay, short and sweet. I think we are going to, I think we're going to call it a day. We're at time. So Cami, thank you so much. I am constantly deeply impressed by the way that you all who do the briefing can both put together these detailed reports, come in, present them, and then take questions that could come from any part of that or even beyond. So thank you so much for everything you do for this. It was great, and I think we got a lot of insights out of that. Thank you all to our attendees and their great questions as always. We appreciate that very much, and that always helps drive those insights in the briefing. So for the media that are with us this morning, we'd love to continue the conversation. If you'd like to talk to any of our experts, Cami, or any of our other economists, you can reach out to me, Rob_Knapp at Kenan-Flagler.unc.edu. For everybody out there, we hope you will visit our website at Kenan-Institute.unc.edu. April is a very, very busy time for us, so there are several things you're going to find on there of interest. We have a conference next week that Cami is a very big part of. It's the conference on market-based solutions for reducing wealth inequality, and that will be here on the business campus in Chapel Hill. So take a look. You'll find some interesting things associated with that. And if you're interested in the area, we'd love to have you. Also, we have a new package up on U.S. manufacturing, which has been part of the headlines because that's tied into a lot of these tariffs we're seeing, trying to protect U.S. manufacturing, help rebuild it. We have several pieces to explore there. And our grand challenge on the skills gap continue. So many things to look at, and I'll send you links for those in the post-briefing email that will go out to everybody who registered a little bit later today. Again, thank you all for coming. Our next briefing is May 2nd. We hope you'll be here for that. There will be plenty of new things to discuss, I'm sure, so don't miss it. Thanks again for being with us, and have a great Friday.
Thanks, everybody.